So without further ado, Chris Rule, everyone, to take us through the global landscape.
Thank you. Thanks, Michael. Thanks, Michael. That was entertaining. We had a stand-up last night. We went out for dinner. The guys from Cape Town were here. Next thing, we were sitting in a stand-up event, and I was getting marked for 35 minutes. So just let it keep rolling, enjoy the flow. We actually want to turn this around a bit. We want to talk about the global investment landscape, zoom out, and then zoom back into our market and have a few ideas of where we think the industry is going, but we actually want to look at it from an asset management perspective. So actually, as asset managers, which obviously form a large part of the ecosystem, what does the shape of that industry look like? What does the health look like? And what does the future look like? So this is not an outlook in terms of asset allocation or asset views. This is actually kind of an industry overview and industry review. So I'm going to go through a whole lot of interesting stats. A lot of this has been amalgamated and kind of like a literature review. We've tried to put together a whole lot of really factual evidence around where flow of assets are gone, where they're probably going, bring it into South Africa, and then maybe have a bit of fun on a parallel. But I don't want to speak for too long. I want to open it up for a lot of Q&A, because I think the way that asset managers change and evolve their business models is going to be hugely impactful on how advisors and intermediaries and end clients see their investment solutions shaping over the next 5, 10, 15 years. So let's have a look at what's happened in the global asset management market. It's almost $120 trillion market, which is like 4 quadrillion. Quadrillion's a real thing. I checked it out. Quad is like 4, and then trillion, 3, and you get it. But this is a huge industry. If you think about the relative size to the JSE, you'd need to stack like 300 JSEs total market cap to get into this total industry size. Huge industry, but not a lot of growth. Only about 6% growth in the last 20 years, which is really interesting because one assumes, given the profile of these businesses, that this is a high growth industry. And of that 6%, over 5 has just come from the market. So like the growth of the industry is actually being driven by the market, not by the industry evolving, changing, picking up new flow of asset, which is also very interesting. Now, what's happened in the last kind of 20 years is we see what everyone talks about as the growth of indexation. And everyone, first of all, quotes 50%, which is wrong. 50% is right if you're talking about US equities, but it's wrong if you're talking about the industry. The growth of indexation and passive has been one story. But really, the other growth drivers in this industry have been alternatives, huge growth. And when we unpack the business and some of the incentives behind this growth, massive. But traditional active management has been what's taken the hit. So it's gone from like a 70% share of market. Traditional, when we talk about active core and active specialists, really this is quite DM-centric. So this talks about like DM equity, DM bonds, etc., and that's EM and listed and public assets. That's gone from a 70% share of market, 2005, 20 years later, call it 44%. So, a massive knock on AUM, and the growth has come out of passive or index and alternates. Alternates and index actually on par now. And there's a lot of talk about alternative investing and talking about the growth of alternatives, but actually on par with indexation. So that's quite interesting because the rhetoric, if you look at mainstream media and so forth, it's just like the passive market is blown up and it's this huge bubble. But when you zoom out and you look at total assets, it's actually still relatively small, 20% share of market. Traditional asset, active management is still larger. And then this interesting little one here, this solutions, LDI, and multi-assets, and you'll see where that weaves in. But this is the trend. Post-GFC, we saw a massive flight to indexation, a massive flight to ETFs. The ETF product wrapper is responsible for around 50% of that growth in index. And that's, in the US, there was a strong tax story there, so there was an efficiency gain by switching to ETFs. But also post-GFC, there was a strong story around transparency, accessibility, and the kind of the highlighting and the elevating of the importance of costs in investment portfolios. So indexation and ETF, they kind of hang together in the global scene, probably less so locally, but they hang together in terms of this massive trend that has driven flow of assets. And then outcomes focus, this solutions, multi-asset LDI framework, this way of thinking, a switch of thinking of risk in terms of the probability of meeting an objective relative to thinking of risk as just downside. And the emergence of DC and so forth, so this transition out of looking at just specialist active building blocks into actually solution builders, and that's really interesting. And then this alternatives thing. Now, alternatives is something that I want to highlight and show the incentive for probably what will be a direction of travel in our market. This is share of revenue. So that was share of assets we looked at, and we know kind of the stack here, 44% traditional active, 50% in alternatives, index, and solutions. But share of revenue is something incredible. This traditional active has gone from 60% share of revenue to 27%. So it's more than halved. So even though their AUM hasn't halved, their share of revenue has more than halved. And that's a function of these guys here who've picked up a paltry 4% share of revenue. So the index players, although they've picked up massive share of assets, haven't actually picked up a massive share of revenue. This is probably good for clients, but it impacts the total industry, right? Because the total industry year on year, although assets are up, revenue's down 8%. And that trend and trajectory of pressure from cost compression that's translating across the industry, and aggregators and buyers of markets creating further cost compression has meant that alternative market has picked up this dominant share of revenue. So the alternative market has picked up 57% of market revenue, but 20% share of AUM. And so we're going to see a lot of talk about alternatives because there's a great incentive to start allocating to alternatives. And this is looking at it not from an investment lens, this is looking at it from a commercial lens, and a commercial lens from how businesses will be built in the future. So it's quite interesting if you just look at what happened in the past and you think, okay, well, what does this mean for the global industry and how we move forward? We could obviously hypothesize, or we could just get what the asset managers themselves think. So this is an interesting survey, and basically 18 of the 20 largest asset managers of the world, their different heads and roles and C-suite responded, and they spoke about their three major trends. The one is customization and personalization. So 80% of these asset managers believe that this will become the differentiator in their product suite. In customization can go as far as individual mass customization or personalization of a portfolio. And you can see it in the US where as an individual you can log on to your account, you can say, well, my preference, my view is ESG. I'll build a multi-asset portfolio with ESG, but I don't really like Tesla, so let's strip that out. And you can actually mass customize and personalize your own portfolio right down to the individual level. And that's kind of as personalization, customization, it happens everywhere in the world that we exist in. As that advances and moves ahead, this is going to become a key trend in our market. That's certainly what the asset managers think. You've got tech and AI. This is kind of always spoken about. But with cost pressure, we need to relieve that. And you need to relieve it by, A, delivering more value to clients, B, ultimately creating more efficiency, removing headcount. I mean, that's the reality. So if you think about asset managers stacked into the front, middle, and back office, we can already see how tech and AI is starting to service clients better, is starting to enable more investment operational efficiency, and is starting to pull through as a key differentiator to unlock and grow revenue inside of asset management business. So this is really critical. And this is not even talking about tech and AI at a portfolio management, portfolio construction perspective. This is inside the business model if you lift it up. And alternatives. I mean, the question is how we democratize alternatives. Legal & General has recently put together a listed alternatives solution, which is very interesting. It's probably the first move in that democratization of alternatives. But alternatives become a massive incentive for asset managers, and they become a massive opportunity for clients to incorporate another asset class into their portfolios that otherwise they wouldn't simply have access to. So the question on alternatives is how does it grow and how does it democratize, and how do we do that without creating a massive asset liability mismatch, right? I mean, that is at the core of the risk of alternatives. So this all hangs together in asset managers probably moving away from product proliferators, selling funds, selling an exposure, to becoming a total portfolio solution. Now that means everything. It means the full stack, and making it available not just to advisors or intermediaries, but to other asset managers. So, you as an asset manager could approach a fellow, like let's say a scaled incumbent, and you could access their asset allocation, their building blocks, their risk platform, and actually, if you don't have the stomach to go and hire a highly paid CIO, you can access a CIO service. Wrap that all in a structure and take it to your clients. Now that sounds maybe a little bit extreme, but it's certainly already happening. If this was last year's BlackRock, these guys are the largest asset manager in the world, as you know. This is their daily investor call. They've already pivoted here. This is where they're going. Their whole strategy is delivering platform for performance to clients. They're talking about now we get software as a service. They're talking about platform as a service. So Aladdin, which becomes like this big tech underpin, and then on top of that, you can pull in risk levers, you can pull in portfolios, you can pull in consulting work, and so on and so forth, and wrapping. So platform as a service, globally, this is the direction of travel. It's very interesting. It's very interesting to see how it unfolds, and there's some very interesting cases in our own market that we'll kind of allude to. The SA market is same, but different. It's kind of, it's much smaller. We know this. This is the pooled market, by the way. It's quite hard to get like very reliable institutional data. The institutional market probably takes you up to more like 7, 8, just to give you a flavor of the size of our market, which is tiny. 14% growth, which is great. This is as we unlocked out of DB to DC, as the life co started letting go of assets, and as the independents and the boutiques, and when I talk about the boutiques, I mean non-life tied businesses, started coming to market. Pretty substantial growth in our savings and investment markets. Only about 60% of this comes from the market, so quite different to the global experience. We obviously tend to be 10 years behind the global experience in terms of the maturity of our asset management market. So really pretty interesting, but still quite a small market, and that smallness in the market is quite critical in terms of how you potentially see this future shaping in our SA asset management market. Here's AUM by category. This is our own work, and I couldn't match it exactly to how the previous results work, but it's kind of similar. So this is CIS single asset and active. This is CIS, the blue here is multi-asset and active. And then we've got rules-based and we've got alternatives. Alternatives is only hedge funds and private equity. So it's not the perfect representation of alternatives, but pretty close. If you think hedge funds, private equity, private credit's kind of starting to grow in the last 5, 10 years, but this is a fairly good representation. So if you think about it, the trend's fairly similar insofar as if we assume we are a bit behind the global experience, we're kind of sitting with 20% total in alternatives and index, and that's where the growth has come again, out of the index space. And we've seen this huge pickup in multi-asset. Multi-asset, in a sense, is like the solutions LDI part of that initial market that's picked up to about 15% globally. And this single asset class active is what's taken strain in our market. So why has that probably happened? Multi-asset grew exponentially, probably off the back of regulatory structural changes. So you've got the introduction of phase, meant risk profiling was incredibly important, and you couldn't just go put your clients in the grey equity fund and close your eyes and hope for the best. You had to actually substantiate a risk profiled approach and risk profile at an advisor level. So phase is critical. That's the early 2000s. You can see the assets start to just move straight out of single asset and into multi-asset. Then you've got Reg 28. Reg 28 and a shift from DB to DC, and then a very interesting shift that happened in like 2013, 2014 is a shift to member level Reg 28 compliance, which meant as a provider of an RA or a big umbrella, you couldn't let one individual have 100% equity and the other was balanced off with someone in fixed income, for example. You actually had to do this at a member level, administratively a nightmare, unless you can say, well, the product they're in is Reg 28. And so we see this huge flight to multi-asset. Index is interesting. I kind of think, and I feel like we've been talking this game for a long time, but it's right in the beginning of its growth curve. If we think about the global experience, 2005 index was about 10%. We're only at about 10% now in our markets. I said 10 years, but it looks more like 20 in numbers. Proof of concept is kind of taking shape. You know, the market intent, and there's a few role players who've shaped that and changed that, but the proof of concept has taken shape. Most index funds have 10 years plus track record. Actually, guess what? The stuff works. All of the myth busting's been done. Now it's in a place where asset allocators are starting to really think critically about how they allocate to asset classes and how much budget, cost, and risk budget they use in their portfolio construction. And then alternatives. Alternatives, we've got retail hedge funds, BN90. Everyone's waiting kind of on the edge of their seats for BN90 to release some more alternatives. And we've got a Reg 28 shifting, and we'll kind of go through that. So the market has accelerated. In 10 years, the rules-based share market's gone from 2.6 to 9.04. That is substantial, and probably accelerates further. Interesting where it's playing out, and probably where the growth is with Reg 28 shifting. If you look at the last kind of, again, 10 years, share of markets picked up in international equity. And that's probably a market view on the core capabilities that our asset management community had, which was predominantly SA equity centric, and then pivoted into multi-asset. But certainly not a lot of votes of confidence in the active market when it comes to global investing, and you can see that in the numbers, and that's pushed the dial big time. So I think we're going to see more increased adoption of rules-based, and the trend is certainly there. Multi-asset's super interesting. There's obviously some of our largest rules-based funds are sitting in this category, but only 6% share of market. And again, the proof of concept starting to pull through 10, 15 years of track record, and suddenly the market sits up and says, hang on, this is a really compelling alternative. So that's the first trend we see, this continued increase in indexation. And you can slice and dice it how you like, but really the adoption for indexation, and some of this comes out of the aggregators, a lot of this does. So we think the customized space in our market's going to grow, and it sounds maybe a little bit unusual, but if you think about the DFM market effectively is personalizing typically at an intermediary level a solution, and that's got about 500 billion in assets, about 11% of our pooled money. The advised assets is about half of our pooled money. That's intermediated and both tied and independent. So the customized solutions market is ripe for the picking in our market. At the moment, most guys are buying something off the shelf. And for how long their clients will accept that as an acceptable solution for their personal goals is the question. And this DFM market, there's obviously just a panel, but is starting to pick up quite a big piece of that customized market. Customization, indexation in our market, and then the big thing is this increased global competition. And this is yes, a forecast, but we've already seen it, right? We've already seen all the partnerships that have come into our market. Suddenly, SA as a target market is far more compelling with offshore regs sitting at 45% from 10, 15. And so increased global competition. And look at where the flow of assets in our CIS market have come. 354 billion since the change in Reg 28. That's like 10% of the CIS market has come into global products. 30% growth in foreign CIS. So we now have to compete with foreign asset management capabilities. And 31% of this comes in local CISs and foreign securities, where a lot of these are actually JV'd with global asset managers. So super interesting that this Reg 28 change has probably created a problem for our local asset management industry in terms of the increased competition and the ability to compete with global competitors. Then alternatives. I mean, two parts at the moment. The illiquid part is small, it's tiny, but it's going to grow. It's going to give asset managers a much clearer view on where they can allocate alternatives and illiquids to. We need to fund SA, we need to fund transition, the energy transition, and there's a lot of regulatory pressure to incorporate alternatives and private assets inside of retirement funds. So basically, we think in the SA market, what we see is fairly similar to the global market, but with a slight tweak on it, probably 10, 15 years earlier. Custom solutions and indexation. This is not mass personalization yet in our market. We still see this at an intermediary level. So it's not mass customization, but it is building custom solutions for clients. That's accelerated through the DFM market and the solutions market. We see increased global competition, and we see alternatives being democratized. Some of these levels that were reset in Reg 28 make it a very meaningful business opportunity for asset managers and a very meaningful contribution to retirement portfolios. So again, looking at asset management, kind of shifting away from product pushing to solutions building, using all of the levers they have at their disposal, and how we transition between this public and private market problem that sits at the core of most portfolios. So that's kind of our outlook, and we think it's really important to understand how that's going to shape our industry. It sounds a little bit far-fetched that you just think about an asset manager as a platform. Like we always think about asset managers in terms of a staff fund manager or a portfolio constructor. But actually, if we think about other industries, and I think the description was something about a polycrisis, which is another thing I had to Google. It's like a whole lot of things that come together that are catastrophic. I don't think we're there, but it certainly is always interesting, and I always like thinking about other industries and how this has happened, how this has crept up on us in our lives without us even knowing. So I don't know about you guys, but I love music. I thought about the music industry because I was lying in bed after doing 23 prezos last week. And I thought about, geez, the music industry is quite an interesting version of how something moves from selling product into platform. And if you think about it, the music industry 20 years ago was selling CDs, and then they were using concerts to promote those CDs and records. And that was the business. That was where all the revenue stacked. And then that music started getting really expensive to own, right? I mean, I can think of asset management in a similar parallel, right? We were selling products and then they got really expensive, and then someone came in and pirated the music. So you could go to Pirate Bay, you could access music for free, and it created a huge problem for the music industry. Fidelity went and did, the S&P 500 for free. It's created a massive problem for the investment industry, right? And then the music industry ultimately had to pivot and change, and it was obviously driven by one or two role players, and I think we'll probably see the same in the asset management world, the likes of BlackRock. But Spotify entered the scene, right? Spotify said, well, actually this cheap music is not sustainable for the industry, or free music rather, stolen music, illegal music. And we think we could create like a streaming service where you can access music for free, and we'll just get advertising revenue, and we'll pay the artists through like a rev share on that. First of all, the guys hated it. The music industry hated it initially. They said, no ways. Like, we sell records. That's the business we're in. But ultimately, that's pivoted into what is music has become a personalized platform that you access as an individual. And I'm about to share my dirty laundry here. So, but here you get an idea of how the revenue split has changed. But music has changed from buying one CD, maybe 10, maybe 100 in your lifetime, to having access to everything you can possibly want, just like having access to every single asset class you could possibly get for virtually nothing. But what you're paying for is the service, what you're paying for is the experience, and where the revenues have switched, and you can see how this industry is moving to streaming as a service. And where this really took off is in the personalization, like the hyper-personalization of music, right? And this is my Spotify thing, okay? So we could focus, studying makes Anton, right there. That's what I do. And I log onto my Spotify every morning. It pops up on my screen on my thing, and I listen to music. The kids always want me to play, like put on the DJ, and then the DJ, hey, Christopher, today we're going to play this. And it's hyper-personalized experience, right? What we're really doing is buying records, right? We're selling and buying records, but the way that it's changed is instant access. Full disclaimer over here, 18 Till I Die is not like my favorite song. We were on the way to school. It was like on Monday or Tuesday, and Robbie said he wanted to drive, who's 3. Abby said, you can't drive, only adults drive. And I said, you've got to be 18 till you drive. And then I was like, 18 till you drive? And then on went 18 Till I Die, and we sang 18 Till You Drive all the way to school. But you get the point. I mean, 20 years ago, one would have never assumed that your music experience would be A, hyper-personalized, be algorithmic and AI driven to send you recommendations that suit your profile, new music that you've never heard of, and B, you would never have to buy another CD. But guess what's really smart here, because behind every smart idea is like a revenue and a profit incentive, is now I pay $90 a month for the rest of my life. That's like 55 grand in today's money that I'm going to spend on music if I live to 87. Assumption. I would have never spent that on CDs this year, but I can access all of that music today. And that's kind of, if you think about the way the world is moving, if you think about how tech is enabling personalization and enabling our ability as intermediaries, as asset managers, not just to sell something that kind of fits, but to sell something that exactly fits a solution, we think that's the way the asset management market's going to move. And it's going to take time, of course, and our market's a lot smaller, so it's going to take even longer, and there's questions about how fragmented and how fragmented the global market is, but how concentrated our market is. But we certainly think this is a massive trend. So that's my time. I've got a big red thing there. But thanks, guys. If there are any questions, we can...
Do you want to take a few questions, or are we going to go to the panel? I think let's take a few questions, because that was a... and it's fine, Chris. I mean, everyone's got a guilty pleasure. Brian Adams. That's fine. Gentleman at the back here.
Chris,
Mark.
thank you so much. It was a great presentation. Really enjoyed it. Maybe just clarify what you mean specifically about personalization in the SA market through an advisor to a client. Because at the moment you mentioned that model portfolios are somewhat personalized to the advisor practice.
Yes.
Mostly just reflect the current industry, actually. With a few tweaks here and there. So what do you mean by personalization through an advisor channel to an individual investor?
Yeah.
Is that what you mean by where the industry is likely to go?
Yeah, I think in the global market, that's likely the route, of course. I think our market, we're probably a bit behind in that trend. And you've seen it in terms of a lot of the online robo solutions that are available in the US market where, tax harvesting based on your state and based on your personal tax circumstance, and then asset allocation and investor preferences. That's certainly at play. Remember, that's just the investment solution. So that's often intermediated to say, hey, as the advisor, what I'm spending my time on is like behavioral traits and tax planning on a forward basis. And this is our investment solution. It's kind of fit for purpose. It's really neat. In our market, we haven't quite seen that. We saw, some of our partners actually like Outvest trying to go that route in terms of this hyper-personalization. You create an individual goal and they create an investment solution for that. That was done not hyper-personalized from the investment solution, but more from the advice journey, right? So the investment solution was actually fairly standardized in the background, for lack of a better description. So I think the personalization in our market is probably a while off. I think it's probably got a lot to do with scale and a lot to do with where our market is in totality from a savings perspective. And the fact that the majority of our market is focused on retirement assets, and the ability to hyper-personalize in that environment becomes more and more challenging. We spoke about some of like the member-level compliance requirements and so forth. So I think we're a bit behind on that. In the discretionary pool, I think we're going to see it grow through some interesting and novel tools, but at an intermediary leg, it's probably going to be customized at an intermediary level, something that connects the intermediary's view of the world with their clients, as opposed to necessarily hyper-personalizes an investment solution for a individual client. Did I answer your question? I said to Mark, you'll always ask hard questions. So he said, but no one answers my questions. So anyway, I hope that went some way towards doing that. Yeah, to customization at an intermediary level. Yeah. Yeah.
Fantastic. Great. Chris,
cool.
A warm round of applause, everyone. Thank you very much, Chris.
Thank you.